Hey everybody, Rob Maurer here, and today we're going to be talking a little bit about the automotive market in China. We've also got an updated analyst note on Tesla from Jefferies, news on Giga Shanghai, Tesla's expansion into Thailand, and a couple of other items as well. Alright, so a couple nice days here for the stock. Tesla today finishing up almost 7.5% to close at $707.73, while the Nasdaq was up 2.7%. And just like that, all of the doom and gloom in the market over the last few days and weeks suddenly feels a little bit lighter, even though there's really nothing that is all that different from a couple of days ago. But the market always makes for an interesting psychological experiment, so it's just something to keep an eye on and notice, which was essentially the point I was making a couple episodes back. Anyway, a couple other quick things on the stock. So first, the GDP estimate, as I mentioned earlier this week, that did come out, so this is the second revision. There will be one more, the next number is then final. But nothing too exciting from this second estimate. GDP previously had been estimated at down 1.4%. Now it has been adjusted to down 1.5% for the first quarter. Then for Tesla specifically, we also had an updated note today from Jefferies. So Philippe Houchois, he has lowered his Tesla price target from $1,250 before, now to $1,050, but still has kept a buy rating on the stock. As for the price target decrease, a lot of the notes seem to center around Elon, saying that, quote, long-held fears of disruption from inside have come true, raising Tesla's risk profile while operating performance continues to set transformative new standards of returns and resource efficiency, end quote. He added, quote, enemy inside and Tesla bigger than Musk is how we have for years framed the risk from Tesla's unconventional leadership and weak governance. It is hard to isolate factors behind the recent correction from NASDAQ to Twitter financial commitments and China lockdowns, but we are clearly witnessing an uncomfortable pileup of negative news, from ratings to polarizing political opinions and ethical questions, end quote. So sure, and we've talked about this stuff, but remember a couple days ago when I was questioning if there had been other high price to earnings stocks that had seen similar compression to Tesla? One of our listeners actually ran that for any company that had a market cap above $1 billion and had a price to earnings ratio at some point in the last year above 100. The day that this was pulled a couple of days ago, the average decline from peak for that group of stocks was 46%. Tesla at that time was down 49%. That data could probably be cleaned up a little bit, but directionally it's very clear that Tesla is not some strange outlier here in this market, despite all the noise that people are going to focus on that just naturally gets amplified anyway because Elon, because Tesla. It's not to say that none of that stuff matters at all, but the degree to which it's impacted the stock, I believe, has been much less significant than what the narratives would have suggested. So that was a good opportunity to share that data, but to get back to the note, Houchois also did comment on Tesla having exceptional fundamentals and said that, quote, Tesla is set to continue generating free cash flow faster than it can build physical product and capacity, with cash expected to be deployed into higher battery vertical integration and or captive financing to support affordability, end quote. So despite some of the questions that they have, that is clearly supporting the buy rating being maintained. All right, next I just wanted to talk a little bit about the automotive market in China. Reuters had a pretty good article on this today. We do have some Tesla specific stuff, but this is a little bit more broad first. So the article headline here is Global Automakers Face Electric Shock in China. They mix in some anecdotes about people not wanting foreign brands anymore in China as much, Tesla being an exception, but the gist of it is that these global brands have been steadily losing market share in China. So they say, quote, global brands have dominated in China since the 1990s, typically winning a collective 60 to 70% share of passenger car sales in recent years. In the first 4 months of 2022, they captured 52%, with their April monthly share at 43%, end quote. I wish they had shared their data a little bit more specifically because I'm not exactly sure if that includes the joint partnerships that a lot of foreign automakers have. And that's obviously a very important distinction, but I think either way, it's an important indicator that foreign brands are losing a lot of strength in China and it's happening very quickly. They included a chart here for sales in China for GM, and the decline since 2017 has been steady despite all the volatility in the recent years. The trend here for GM, and it seems more broadly, has been quite negative. Reuters also ties this into rising electric vehicle sales, noting that foreign brands, again, outside of Tesla, have not been able to find much success with their EVs in China. They point out that the top-ranked traditional car maker for electric vehicles is Volkswagen's partnership with FAW Group, which is only 15th in EV sales. We've talked before about reports of Volkswagen struggling a little bit with demand for the ID vehicles in China. Of course, especially early in a ramp up, you have to be very careful about judging any individual market solely on its own because production allocation can affect those things. But regardless of the reason, there's clearly this gap in the market that new EV makers in China are filling and taking advantage of. I mean, we've talked about this for a long time with Chinese companies probably being the main competitors for Tesla, and I think we're seeing that play out domestically in China. We'll see how that goes in other markets, but it's pretty clear that this is going to be a very, very challenging market for other automakers to succeed in. I would not be at all surprised if in the next few years we see some automakers withdraw from the market, whether that's brands, models, or entirely. And it seems like there's already a little bit of foreshadowing of that happening. Nissan CEO apparently told Reuters that some brands could, quote, disappear in 3 to 5 years, end quote, in China. There's already the pressure of going electric, already the pressure of cannibalizing their own ICE business, competing with Tesla. Then you throw in a bunch of Chinese competitors, which maybe don't have to deal with joint partnerships, maybe have a little bit more government support, the weight of a legacy business, a lot of potential advantages. It's just an extremely tough proposition for these legacy companies and those legacy brands, which frankly are tied to that old era. The last couple of years have been a lot of promises, a lot of talking, but we're finally heading into the period of time now where the electric vehicle business is starting to become big enough to impact companies' financials, impact the marketplace, and start to actually shake out the winners and the losers. And those that are on the losers' trajectory, it's going to be pretty clear pretty quickly. They're going to lose a lot of support, and that downward spiral can happen very quickly. So it's going to be an interesting couple of years, and the Chinese auto market is going to play a big role. Anyway, as for Tesla specifically in China right now, we do have an update from Jay in Shanghai, who shared some drone footage of Tesla loading their 4th export shipment from Shanghai earlier today. So Tesla continuing to export vehicles. I don't think ship tracking is going to be super important this quarter, aside perhaps from the date of the ships leaving and how close those are to the end of the quarter. But it's definitely nice to see that activity, and Elon did reply to this on Twitter, saying that he has so much respect for the Tesla Shanghai team. There is also some good news on Shanghai's port in general. The Ministry of Transportation in Shanghai has announced that the daily container throughput has reached 95% of normal pre-lockdown levels. So that bodes well for Shanghai in general. That's extremely helpful for a lot of businesses. Tesla definitely benefits as well. Good to see. All right, next up, we've got some exciting news on Tesla and Thailand, and I do apologize. I actually had this on my notes yesterday, but somehow throughout the day, it did fall off. But Tesla has officially registered a subsidiary in Thailand, according to documents filed with the Department of Business Development. This actually happened back on April 25th, but seems to have just been noticed in the last couple of days. This does cover Tesla selling cars and energy storage systems. Thailand is a right-hand drive or left-hand traffic country, and their auto market is about 1 million vehicles per year. So pretty decent size, somewhere between 15th and 20th in rank. And for a little bit more context, BMW and Mercedes sell somewhere around 12,000 vehicles there per year. So without much further research, I don't think Tesla should have any trouble exceeding those levels. All right, last couple of items here. First, we've got some new information on a new vehicle from BYD, the BYD Seal, which is particularly interesting because they say this will be their first vehicle using their cell-to-body structural battery. So they've announced specs and pricing. This will start at the equivalent of about $32,000. Seems to be about 20% cheaper than the Model 3, and apparently the range on the CLTC test cycle, so it's kind of hard to translate that in EPA, but CLTC test cycle, apparently 342 miles of range for the base version, and then up to 435 miles on the rear-wheel drive long-range version. Those ranges are roughly equivalent to the ranges that Tesla lists for the rear-wheel drive and performance Model 3 in China. So BYD has opened reservations for the Seal. They don't say exactly when deliveries are going to start, but it's expected to be sometime later this year. And obviously there's more to a vehicle than price and range, but it does look like it should be a pretty compelling competitor. One to keep an eye on for sure. All right, last item for today, just kind of a follow-up to what we had previously discussed about Tesla being removed from the S&P 500 ESG index. The SEC is currently proposing changes to the disclosure requirements for ESG funds, noting that there is a lack of disclosure requirements and common disclosure framework tailored to ESG investing, which can make it harder for investors to understand those investments. One major change would be the requirement for greenhouse gas emissions reporting for the companies the fund is comprised of. Presumably that would give a little bit more of a standardized basis for comparison across these different funds. I think the intent is generally in the right direction. We'll see if the actual changes, if they do happen, capture that intent. I'm a little bit skeptical of that, but I haven't had a chance to read through the entire proposal that they have. So kind of tough to say, but wanted to at least pass along that that is something that is being discussed. All right, that is it for today then. As always, thank you for listening. Make sure you're subscribed and signed up for notifications. You can also find me on Twitter at Tesla Podcast, and we'll see you tomorrow for the Friday, May 27th episode of Tesla Daily. Thank you.